Hi guys, this is CA Balakrishna. In this video, we will be discussing case study number 13. Basically, all the MCQs of this case study number 13 can be answered without even reading the case study. Let us see. MCQ number 1. ORL had given loans to MEL as well as WTL respectively for the purpose of their ventures. Okay. That means ORL is a financial creditor of MEL as well as WTL, okay, and had also given some raw materials to both the companies on credit which remained unpaid. That means ORL is also a operational creditor to these MEL as well as WTL, okay. Hence, for the purpose of Insolvency and Bankruptcy Code 2016, it can be said that ORL is a both financial creditor as well as operational creditor to the extent of the debt. The answer would be option number C. Partly operational creditor and partly financial creditor. Okay. Next. The resolution plan as received from AGPL by the insolvency professional contained a provision for combination as referred to in section 5 of Competition Act 2002. In such a case, who shall take the approval and approval of which authority is required if resolution plan is to be considered by committee of creditors? See, basically there is some corporate insolvency resolution plan going on now, resolution process going on. For this process, AGPL, a resolution applicant, has submitted a resolution plan. In such a resolution plan, it has proposed for a combination. Okay, whenever a combination is involved and it is in excess of the threshold limits that has been prescribed under Competition Act, then prior approval of CCI is required. Okay, only after prior approval of CCI, the resolution plan can be approved by the committee of creditors. Let us see. First of all, who has to approve the approval? Who has to obtain the approval? AGPL. Okay, resolution applicant has to obtain the approval. Okay, AGPL shall take prior approval of Competition Commission of India. Fine, this would be correct answer. Next. Mr. Rajesh Panchal, keeping the facts and circumstances in mind, formed the committee of creditors. The COC would consist of, basically committee of creditors consists of all the financial creditors. Okay, it will not contain operational creditors. Now, who will be present in this committee of creditors? Bank will be present. LPL, basically LPL is a operational creditor. It has supplied some software, okay, to the corporate debtor, thereby it would be operational creditor, and operational creditor will not be included in the committee of creditors. Here also he given LPL, no. Bank and ORL, okay, ORL is both financial creditor as well as operational creditor. Now, to the extent of its financial debt, it will be included in this committee of creditors. Thereby, bank and ORL to the extent of its financial debt would be, creditors included in this committee of creditors. Next, Manish Mehra purchased a flat in Mumbai in the name of his son Jubin from his savings, but Jubin upfront denied the ownership of the flat. This transaction is a valid transaction. Even though Jubin has denied the ownership of the property, this person Manish Mehra has purchased the flat from his known sources and he purchased it in the name of his son. Okay, thereby this transaction would be a valid transaction even though his son has denied the ownership. Next, Mr. Manish Mehra has entered into an MOU for the mulchage premises with TBPL. Basically, TBPL is a promoter of particular real estate project, but On account of lack of funds and financial difficulties, TBPL could not complete the construction and hand over the premises to TBPL within the time limit specified in the MOU, and assuming that there was default on part of TBPL to return the funds to Mr. Manish on his application for withdrawal from the project, Mr. Manish has recourse under. See, basically the memorandum of understanding was like this. Manish would enter into lease agreement regarding the property for a period of 99 years, and for this lease he would be paying an upfront fee of 50 lakh and 500 per month, I think per month or per year, that would be present in the case study. Let's say per year. These are the terms of the memorandum of understanding. Basically, even though it is lease for 99 years, the terms of MOU are such that it is a sale transaction only. Okay, because lease is for almost 100 years and almost entire consideration is being paid. Just a nominal amount of 500 per year is charged as a lease rental, which is similar to that of a sale transaction. Therefore, this would amount to sale of real estate project, and it would be within the scope of this Real Estate Regulation Act. Therefore, the person can have recourse to Real Estate Regulation Act, as well as an allottee can have recourse to Insolvency Bankruptcy Code also. Okay, he can initiate IBC proceedings against the promoter, and also he can have recourse under Consumer Protection Act as well. Therefore, answer would be option D. He can have, the allottee of the real estate project can have recourse to all these three authorities. Next, advise whether Mr. Manish Mehra can take legal action under section 18 of the Real Estate Regulation and Development Act 2016, assuming that RERA is in force and the said real estate project of TBPL is registered thereunder. See, we have already discussed in one of the MCQ that even though it is in the form of a lease, the terms of lease are such that it amounts to a sale transaction. Okay, as per this case law, Lavasa Corporation Limited versus Jitendra Tulsiani. Now that would be within the scope of RERA, and if promoter fails to complete the project within the time that has been prescribed in the agreement between promoter and allottee, then allottee can withdraw from the project under section 18 and the promoter has to pay back the amount that allottee has given. Thereby, Manish Mishra can take recourse under RERA Act under section 18. Next, the bank decided to enforce the personal guarantee given by Mr. Arjun Malhotra, but he responded that the demand is not maintainable in the pretext of the ongoing corporate insolvency resolution process against MEL and WTL, and moratorium was declared under section 14 of IBC. See, moratorium was declared on the assets of MEL and WTL, but not on the assets of personal guarantor. Okay, thereby bank can enforce the personal guarantee that has been given by Mr. Arjun Malhotra. Okay, this Mr. Arjun Malhotra can't say that there has been moratorium going on his property. Okay, the moratorium will be only on the assets of corporate debtor on whom insolvency process is being initiated. Okay, but not on the personal guarantors of the corporate debtor. Hope that is clear. Next, LPL is aggrieved as it was not given preference in the resolution plan. See, LPL is a operational creditor. Operational creditor is not included in the committee of creditors. Only bank and ORL are included in the committee of creditors. Okay, now LPL is aggrieved that it was not given preference in the resolution plan and submitted its plea to the NCLT to make necessary amendments to the resolution plan. LPL is of the view that on grounds of equity and fairness it should be paid in the same proportion as the bank and other financial institutions. See, if you see, the resolution plan that has been approved by the committee of creditors must provide for payment of debts to operational creditor. Also, such payment must not be less than the amount that the operational creditor would have received at the time of winding up under section 53. Okay, the amount that the operational creditor is going to receive under this resolution plan should not be less than the amount that he would have received in the case of winding up. That is the condition. But there is no specific condition that operational creditor must be given the amount that has been taken by the financial creditors. Okay, based on the commercial wisdom of the committee of creditors, the amount will be paid to the operational creditors, but such amount must be more than the amount that he would have received in the case of winding up. Thereby, this plea which has been raised by LPL is not valid. Okay, based on the commercial wisdom of this committee of creditors, whatever the amount they want, they can give to the operational creditor, provided it is more than the amount he would have received in case of winding up. Hope that is clear. That has to be the suggestion given by you. By this we have completed case study number 13.